Did you know that despite a national 3.9% year-on-year price decline in April 2025, Canada's housing market is showing remarkable regional resilience? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Canada's housing market has been navigating through a period of volatility shaped by high interest rates, trade uncertainties, and shifting demand. Yet, beneath the surface, regional markets are exhibiting signs of resilience, offering strategic entry points for investors. According to Charles Hayes, in his article, Resilience in Canada's Housing Market, Strategic Entry Points as the Sector Nears a Bottoming Process, certain areas in Canada are aligning with structural shifts in supply, demand, and policy, presenting critical opportunities for investment. The Bank of Canada has played a pivotal role in stabilizing buyer sentiment, with aggressive rate cuts, reducing the overnight rate to 2.75% by March 2025. While major markets like Toronto and Vancouver are still facing challenges with oversupply and weak absorption rates, cities such as Quebec City, Edmonton, and Calgary are defying these trends. Quebec City has witnessed a 13.4% annual price increase driven by population growth and a surge in construction starts, while Edmonton and Calgary benefit from e-commerce expansion and zoning reforms boosting housing supply. The suburban multiple-unit residential segment is particularly noteworthy, with cap rates rising to 4.65% in the first quarter of 2025, reflecting strong demand for affordable rental housing. Cities like Ottawa and Winnipeg stand out where population growth outpaces housing starts, and asking rents remain resilient. This highlights the importance of understanding the interplay between inventory levels, cap rates, and demographic trends to unlock value in the market. Government interventions are reshaping the housing landscape, especially in Saskatchewan, where policy changes have increased allowable housing density and fast-tracked permits, resulting in a 16.8% rise in construction costs, but also accelerated supply. Regina's focus on multi-unit developments, now making up 27% of completed dwellings, exemplifies how zoning reforms can address affordability challenges. In contrast, British Columbia's high policy rate and restrictive development charges have led to a significant surge in unsold inventory in Vancouver. While this presents a challenge for developers, it also offers potential buying opportunities for investors seeking discounted assets. Strategic entry points are emerging in industrial and logistics hubs like Edmonton and Calgary, driven by their proximity to U.S. trade corridors and e-commerce growth, despite the need to monitor U.S. tariff threats and inventory saturation. Suburban residential markets in cities like Ottawa, Winnipeg, and Halifax are experiencing strong demand for rentals, driven by affordability constraints in urban cores. These markets offer cap rates in the 4.5 to 5.0% range, while asking rents have declined modestly. Meanwhile, affordable housing in the prairies, particularly in Saskatchewan and Alberta, is becoming increasingly attractive due to lower price-to-income ratios and population growth. Despite the cautiously optimistic outlook, risks remain. Trade tensions with the U.S., high construction costs, and labor shortages could impact recovery in export-dependent regions like Alberta. Investors are advised to prioritize markets with structural demand, such as those experiencing over 2% population growth and policy support like zoning reforms and tax incentives. Diversifying across asset classes by mixing industrial, residential, and retail can also hedge against sector-specific downturns. Canada's housing market is indeed at an inflection point. While national metrics remain weak, regional dynamics suggest a bottoming process is underway in select areas. The path forward for investors involves focusing on markets where policy, demographics, and capital flows align. As the Bank of Canada continues to ease rates and construction pipelines adjust, the next wave of growth is likely to emerge from the prairies, Quebec, and suburban corridors, setting a blueprint for resilience in a sector poised for rebalancing. Let's dive into the recent developments from the Canada Mortgage and Housing Corporation, or CMHC, regarding their improvement mortgage loan insurance. This program is designed to offer greater financing choices for home buyers who are either purchasing homes that need some work or are building new homes from scratch. It's a significant step in making financing more flexible for both home upgrades and new construction projects. With CMHC improvement, insured financing is available up to 95% of the as-improved value for 1 or 2 unit owner-occupied properties and up to 90% for 3 or 4 unit properties. This means that down payments are based on the lesser of the market value or the purchase price or cost of construction, making it easier for buyers to finance their residential property purchases or improvements with lower down payments. The program details also include flexible advancing options for small or large-scale improvements and new construction. For new construction projects, CMHC insured financing and any equity in the land must be used to facilitate construction and completion of the project. It's important to note that condominium construction financing isn't permitted under this program, and loan advances on vacant land are also not allowed. For those managing the construction themselves, the CMHC Improvement Program supports both owner-built homes and contract-built homes. In the case of owner-built homes, the borrower must hold the title to the land by the first advance, and either perform the work themselves or manage the construction. Contract-built homes require a single builder to construct the home, with the borrower holding the title to the land by the first advance. Progress advance options are available for new construction loans, with CMHC validating advances for up to 4 consecutive advances at no cost under their full-service option. This can be a great way to manage funding over the course of a project, especially for improvements that are greater than 10% of the as-improved value. For smaller improvements, costs that are 10% or less of the as-improved value are eligible for single advances. Another key feature is the requirement for a new home warranty for all new homes, ensuring that there is evidence of enrollment in a recognized new home warranty program wherever they are available. This requirement applies even if it's not mandated by the local law, and for owner-built homes exempt from warranty requirements, an occupancy permit or a third-party report confirming compliance with applicable bylaws and regulations is necessary. The CMHC Improvement Mortgage Loan Insurance also extends to small rental loans for non-owner occupied properties with 2 to 4 units, with a loan-to-value ratio of up to 80%. This offers a valuable opportunity for investors in the multifamily segment to leverage insured financing for their projects. By offering insured financing with reduced down payments and flexible advancing options, the CMHC Improvement Program makes it more accessible for Canadians to invest in their properties, whether through renovations or new builds. It's a positive development that aligns with the growing demand for housing upgrades and new construction, helping to address housing needs across the country. Let's turn our attention to SmartCentres Real Estate Investment Trust, one of Canada's largest real estate investment trusts, known for its vast portfolio of retail spaces. According to a report by MarketBeat, the Royal Bank of Canada has recently raised the price target for SmartCentres from 28 Canadian dollars to 29 Canadian dollars, suggesting an upside potential of nearly 9% from the previous close. This adjustment reflects confidence in the trust's performance and potential for growth. The report also notes that other financial institutions have made similar adjustments. Scotiabank increased their price target to $27.50 Canadian dollars, while National Bank shares raised theirs to $25.25 Canadian dollars. These updates indicate a positive outlook for SmartCentres, which manages approximately $9.5 billion in assets and 34 million square feet of retail space, predominantly anchored by Walmart. It's worth noting that SmartCentres has a significant presence in the retail sector, which has been undergoing various transformations. Despite challenges in the retail industry, the Trust's strategic partnerships with strong national and regional retailers continue to bolster its resilience. With a market capitalization of 3.85 billion Canadian dollars, a price-to-earnings ratio of 16.23, and a beta of 1.25, SmartCentres remains a key player in the Canadian real estate landscape. The Royal Bank of Canada's outperform rating on SmartCentres highlights the trust's robust positioning within the market. As investors seek opportunities in the multifamily and retail segments, SmartCentres' strategic focus on value-oriented retail centers positions it well for future growth. The recent price target increases by major banks underscore the trust's potential to deliver strong returns for investors. As we continue to navigate the complexities of the real estate market, it's essential to identify companies like SmartCentres that demonstrate resilience and adaptability. Their ability to manage and expand their portfolio in a challenging economic environment is a testament to their strategic foresight. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.